Hello everyone, welcome to our channel. If you're eager to learn about derivatives trading, especially options, you're at the right place. We know options trading is risky and is not meant for those with a casual laid-back approach. That's why having a serious approach to options trading is an absolute must. As we always say, a serious approach is built on the back of three core fundamentals: serious research, serious risk analysis, and serious discipline. Today, we'll talk about serious risk analysis. Options can be a potent part of your portfolio, but with great power comes great responsibility, especially when it comes to risk. This topic can seem a bit complicated and intimidating, especially if you've incurred losses. We'll try to simplify it today. We'll cover recognizing time sensitivity and technicals of options trading, recognizing the types of risks that you could encounter while trading in options as a buyer or seller, the risk-reward ratio you should keep in mind in your trades, and two key ways to manage risks: diversification and hedging. Let's jump in. We know that entering into an options contract gives you the right but not the obligation to buy an underlying stock or an index at a predetermined price. Now, this might sound straightforward, but there's a lot to consider before you dive in. It's crucial to understand that options are time sensitive. They have an expiry date, and as that date approaches, their value can change drastically. Keeping a close eye on technical indicators such as price action, candlestick charts, and Dow theory becomes necessary. The introduction of weekly options has added a new layer. These are short-term contracts that expire within a week. A lot has been spoken about how making money from derivatives trading, especially options, is very simple. Considering all these distractions, it becomes all the more important for traders to start becoming serious about trading. It becomes our responsibility to protect ourselves from potential losses while trading. A very effective way to do this is by conducting a thorough risk analysis before diving into the world of derivatives and options trading. A good trade is one where the potential profit is much higher than the potential loss. Now, let's talk about the risk associated with trading in options. The nature of the risk you have to manage will depend on whether you're buying or selling options. Let's check them out one by one. For those buying options, whether call or put options, you're looking for the chance to make a profit if the stock price or index moves in your favor. But you need to manage your risk carefully, because as a buyer, you stand the risk of losing the entire capital in terms of the premium paid to buy the option. Think of it this way. It's like you're putting your money into a project that has a deadline. You pay upfront, that's your premium. If the project takes off before the deadline and is successful, you make a profit. But if the project doesn't work out, your money is gone. Also, as an options buyer, we must be careful not to keep buying or averaging our position if the trade is going against us just because the premiums are reducing. For an options seller, the risk can be even greater. You might find yourself obligated to buy the option at a price where you lose money. The probability of winning as an options seller or writer is higher, but the risk is unlimited. Your gain is limited to the amount of premium you receive upfront, but the risk of your loss is unlimited if the position goes against you. Now that you have understood the difference between option buying and option selling, let's now understand the key risk analysis to be done in option trading. Whether you are an options buyer or seller, the main risk analysis you have to do is finding the risk-reward ratio of a particular trade. Whether you're buying options or selling them, the risk-reward ratio should be at least 1:2 in your favor. What this means is, let's say you buy an options contract at a premium of 100 rupees. Your probable downside or risk should be half of your probable upside or profit for it to fulfill the 1:2 risk-reward criteria. So, if you place a stop loss of 80 rupees, you should accept this trade if and only if your options contract has the potential to touch a target price of 140 rupees. Now let's understand risk mitigation approaches. Hedging our positions is one effective strategy to mitigate risk to a great extent. Hedging refers to selling out of the money options if an option was bought earlier, and conversely buying out of the money options if an option was sold earlier. Diversification is the second approach to risk mitigation in options trading. It is a strategy of spreading out your investments across different types of options and underlying assets to reduce risk. Putting all your money into one trade can be risky if that trade doesn't go well. Instead, split your investments into various options across different market sectors, strike prices, expiration date, or even strategies. This way, if one option performs poorly, the loss can be balanced out by gains in others, helping to protect your overall portfolio from losses. The market is unpredictable. Prices can soar or plummet in response to news, trends, or economic changes. But with a serious approach to trading philosophies that Sharekhan holds in high regard, serious research, serious risk analysis, and serious discipline, you stand a good chance at being successful while navigating the world of options trading. Because after all, nothing can be taken for granted in the markets, and the markets are all about probabilities. So remember, successful trading is not about making quick money. It's about smart planning, solid research, careful risk assessment, and consistent discipline. As we conclude, keep in mind that preparation and the effective use of strategies are rewarded in the market. You have the tools and knowledge at your disposal. It's time to apply them. So, to sum up this video, we talked about the importance of risk analysis. In this, we covered time sensitivity and technicals of options trading, recognizing that risks are different in nature for options buying versus options selling. The main thing in doing risk analysis is knowing the risk-reward ratio you should keep in mind. We established that keeping it at 1:2 is the ideal way to trade. Finally, we covered two key ways to manage risks: diversification and hedging. If you found value in this video, hit that subscribe button and do share it with your friends.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.